Hey everybody, and welcome back to Investing with Wesley. In today's episode, I'm going to carry on the conversation we had in our last episode up here on college savings plans. In the last episode, I talked to you about a Coverdell ESA plan. And in today's episode, I'm going to talk to you about a 529 college savings plans and what the differences are between the two of them. So with that being said, let's get into it. Now, just like a Coverdell, a 529 plan is designed for college savings. And the 529 plan works a little bit different. For starters, the 529 plan is named after the federal IRS code of 529. However, each 529 plan is sponsored by each individual state. And yes, you can have a 529 plan that is sponsored by a different state than what you live in. And you can also have a 529 plan in that particular state, but go to a college in a completely separate state. So they're very liquid and very forgiving when it comes to the state constrictions. The only thing that really matters when it comes to the state level is whether or not you have more or less tax advantages by opening up and investing in this 529 plan. We'll get more into that a little bit later. The 529 plan uses after-tax dollars to invest and grows tax-deferred. So if you remember the lessons on traditional versus Roth, a traditional uses pre-tax dollars and grows tax-deferred, while a Roth grows after-tax dollars and grows tax-free. This 529 plan is kind of a combination of the two, to where you don't receive a tax-deductible write-off because you're using after-taxed dollars. But it does grow tax-deferred, just like what would be in a traditional. Now, if you use the money that you've grown and invested in this 529 plan for a qualified educational expense, that money will be completely tax-free and you won't owe a dime in taxes for using it towards qualified educational expenses. And although typically people use this for college savings, you could also use the assets in this account towards K through 12 schooling to pay for things like private school tuition and other sorts of fees. However, if you do use this money for anything that is not a qualified educational expense, you will have to pay taxes on that income, and you also will have to pay a 10% penalty fee. As mentioned a moment ago, 529 plans are sponsored by each individual state, and that you also can invest in other states' 529 plans. Choosing the right state-sponsored 529 plan really just depends on a couple of things. One, what kind of tax breaks are you allowed to have? Two, what fees do they charge? And three, what are the investment options that that particular state allows you to invest in with their 529 plan? Now, when it comes to the 529 plan in general, there are typically two kinds. The first one is the traditional version of a 529 plan, where it is an investment savings vehicle that you connect to a portfolio and let that grow over time. The second version of a 529 plan, however, is a prepaid tuition plan. I won't go over that version much in this video because in my opinion, it's pretty flawed. You're prepaying a tuition to a particular college, but what if your child doesn't want to go to that college or doesn't want to go to college in general? At that point, you're kind of screwed. So why would you even choose that option? So being that in this video, we're going to talk mostly about the first option, let's talk about the different investment options that come in the standard investment portfolio kind of 529. Typically with this version, you have three different options when it comes to investing. You can choose a already pre-built portfolio, and there's usually a bunch of different ones to choose from depending on how aggressive or conservative you want to be. You can also use a target date fund. And a target date funds are creative things where basically as your child gets closer and closer to needing that money and gets older and older, that money will move into less and less aggressive accounts automatically based on your child's age. And the thought with this is that as your child gets closer to needing the money, we don't want to open that money up to market risk and have it dip 10-20% overnight. But it's also been my experience that using target date funds gives you less growth than pre-built portfolios, or the third option, which is professionally managed portfolio, where an investment manager handles your 529 plan and invests it themselves. This option is more rare than the first two, but it is well worth it if you can get your hands on someone that is very experienced with what they do. But because in reality, investment managers that are very good at what they do are hard to come by, or aren't very consistent with their performance. As a general rule of thumb, if you were to open up a 529 plan, I would more often than not recommend you put it into a pre-built portfolio and avoid the target date funds and investment managers because they're just not as consistent as I like to see, especially when I'm not saving for extremely long periods of time like retirement. I'm saving for a relatively short amount of years for college. Another real cool thing about the 529 plan is that your beneficiaries can be switched often and pretty much at any time. If it turns out that your first child doesn't want to go to college, you can easily switch the beneficiary of that 529 plan to a different kid. Or if you have multiple kids and none of them want to go to college, you could switch that beneficiary to a niece, nephew, or any other minor that is in your family. Now, when it comes to a 529 plan, there is no contribution limits, which is a huge thing. Especially if you remember in our last video where we talked about Coverdell ESAs, they have a $2,000 yearly limit. So if you wanted to put away massive amounts of money, you couldn't do that in a Coverdell. But you can do that within a 529 because there are no limits. Now, I say there's no limits loosely because there is still something called a gift tax exclusion. And in 2020, as well as this year in 2021, that limit is $15,000. Now, of course, you can gift more than $15,000 in a single year, but any dollar you gift past that $15,000 mark, you have to file a tax form on that money so they can keep track of that. And that's because anytime you give a gift in excess of $15,000 in a single year, the amount over that $15,000 mark gets deducted from your lifetime estate tax exclusionary dollar amount. Now, I'm not going to get into estate taxes with you in this episode because this episode is completely about college savings plans and 529 plans. But just know that this is more of a headache and an administrative cost than you really have to worry about it. Unless you are ultra wealthy with more than 8 figures of net worth, you do not have to worry about hitting this number. So that's why I say there's really no limit, because the majority of people out there don't have 8-figure net worths. So you can gift as much money as you want. And yeah, you'll have to file those tax forms, but at the end of the day, it's really just an administrative cost and it doesn't really affect you. Now, when it comes to the fees of a 529 plan, they vary wildly between the different states. So you definitely want to do your research on the tax breaks as well as the fees when it comes to what state you want to pick and invest this program into. As well as the options for investing are pretty limited. I'm typically not a fan of choosing pre-built portfolios because often they don't keep track with the general market itself. So you're not capitalizing on as much gains as you could be. With that being said, the 529 plan works very similar to a 401k or 457 retirement program, where you can't actually pick the stocks you want to invest in, but you can pick the level of aggressiveness in your portfolio. So although there is no annual limit to how much money you can throw into this account, I will say that not being able to pick the individual stocks in this portfolio is a huge drawback for me. And that is one of the main pros that I had with the Coverdell ESA account. Now, it's very safe to say that the Coverdell had way more cons than pros, but being able to pick your own investments is something I'm really into, and not so much being able to pick a pre-built portfolio. Now, when it comes to options between a 529 or a Coverdell ESA, chances are I would actually recommend the 529. But there are more ways and strategies you could invest and save for your kids' college tuition, and they are not limited to these two accounts. But for now, since we've only talked about these two, right now, the 529 plan, in my opinion, takes the lead because there's no limit, so you could park as much money into it as you want. Depending on what state you live in and what state you have your 529 plan in, you have tax deductible benefits, and the beneficiary could be changed at any time. So in my opinion, there's a lot more pros than there are cons when it comes to the 529 plan. But like I mentioned a second ago, these two accounts aren't the only college savings accounts out there. There are also UGMA accounts, Roth IRA accounts that can be used towards education, and there are also more beneficial tax strategies out there, especially using a family 501c3 nonprofit corporation. This is something I haven't talked about yet in any of my videos. But if you've managed to talk to me in person and you're watching this, you'll know exactly what I talk about because I talk about it all the time, setting up a family nonprofit. But we'll get into the Roth IRA, the UGMA accounts, and all the other ways you can invest in college savings accounts for your child in a later video. If you want to learn more about my family nonprofit strategy, feel free to comment down below and I'll gladly talk to you about it. But in the meantime, if you feel like you got value from this video, please remember to like and subscribe because it really helps the YouTube algorithm and getting this channel out there to educate and grow and help more people with the very important topic of personal finance and investing. And until our next video, have a good one.